How does a company with revenue plunging like 44% and worsening net losses just suddenly rip upward to hit a massive 52-week high of $74.53?
Right, it makes no sense on paper.
I mean, is Aehr Test Systems, ticker symbol AEHR, the ultimate AI breakout stock? Or are retail investors just, walking straight into this highly dangerous, overvalued value trap?
That is the defining paradox of the semiconductor market right now, honestly, because the current financials, they paint a picture of a company in severe contraction.
Yeah.
But then you look at the price chart and it looks like a rocket ship defying gravity. It's just a complete disconnect between what's happening today and, well, what the market is pricing in for tomorrow.
Welcome to today's deep dive, everyone. It is Monday, April 13th, 2026, and our mission today is to dissect this absolute whirlwind of conflicting signals surrounding Aehr.
There are a lot of them.
So many. We're going to unpack the financials, look at the really violent technical momentum, and uncover the hidden risks to figure out what is genuinely driving this stock.
And we definitely need to look closely because the divergence here is historic.
Exactly. Now, before we get into the actual numbers, do make sure you like the video and subscribe to our YouTube channel. And it is absolutely compulsory that you leave us a comment with your feedback.
We really want to know if you are buying or selling this narrative.
For sure. Are you guys buying this as the ultimate AI breakout? Or is it a trap? Drop a comment. And just a quick reminder, this is not financial advice. Just an objective look at the facts.
Right, and we're looking at a fundamental reality that just seems entirely divorced from the stock's parabolic price action over these last few trading sessions.
Okay, let's unpack this, because looking at their recent Q3 fiscal 2026 earnings report, which, just dropped a few days ago on April 7th, the market reaction feels completely upside down.
It really does.
Let's just pull up the income statement. Q3 net revenue dropped 44% year over year. They brought in just $10.3 million.
Which is rough.
Yeah, and their GAAP net loss worsened to negative $3.2 million. Plus, GAAP earnings per share dropped to negative 10 cents.
Right, so if you stop reading at those top-line numbers, it's incredibly bleak. But there was a tiny silver lining on the income side.
What was that?
Well, their non-GAAP earnings per share came in at negative 5 cents. So they actually beat Wall Street estimates by 7 cents.
Wait, let me stop you there for a second, because that whole GAAP versus non-GAAP distinction always trips people up.
But for sure.
When we say non-GAAP beat estimates, we're talking about stripping out certain accounting costs, right?
Mm-hmm.
What are they actually removing to make that number look, less terrible?
Primarily, non-GAAP figures strip out non-cash expenses, like stock-based compensation.
Right.
So companies pay their executives and engineers in stock, which is a real expense, but it doesn't pull physical cash out of the company's bank account today.
Got it. So it's just paper money, essentially.
Exactly. By looking at the non-GAAP number, analysts are trying to see the underlying performance of the core business engine. And, well, while that engine is running slightly smoother than the headline implies, it's still a company shrinking its current revenue footprint.
And bleeding cash.
Right, bleeding cash.
And, this isn't just a one-off bad quarter either. If we zoom out, their fiscal 2025 revenue was down to $59 million from $66.2 million in fiscal 2024.
Yeah, it's a trend.
The data points to a massive structural slowdown in their core silicon carbide market, which is heavily tied to the electric vehicle sector, right?
Yeah, the EV market has cooled off dramatically over the last couple of years. And because Aehr makes the specialized equipment used to test those specific silicon carbide chips before they go into the cars.
When the automakers tap the brakes on production, Aehr just takes the hit directly.
Exactly. But despite all of that terrible historical data, the stock spikes. It hits a 52-week high.
It's insane.
What's fascinating here is how perfectly this illustrates the aggressive, forward-looking nature of the stock market. Buyers aren't paying for the revenue Aehr lost in the EV market yesterday.
Right.
They're paying for the contracts Aehr just signed for tomorrow. So while current revenue was dismal, their bookings were explosive.
Looking at the income statement, it's kind of like a restaurant with no customers tonight. But then you look at their reservation book and they have millions in catering gigs booked for next month.
That's a great analogy. It's exactly like that.
Okay, but a surge in bookings is easy to claim when your previous quarter was just awful. Are we talking about a legitimate paradigm shift here, or is this just a favorable, year-over-year mathematical comparison?
No, it's a legitimate structural shift. Bookings surged 122% to $37.2 million.
Wow.
And more importantly, that fresh influx of orders pushes their effective backlog to a record high $50.9 million.
That is massive.
It is. When institutional buyers, the hedge funds and the massive asset managers, looked at that April 7th report, they completely ignored the 44% revenue drop.
They just didn't care.
Right. They absorbed the negative news because a $50.9 million backlog represents virtually guaranteed future revenue.
So they're essentially saying, we don't care that the factory is quiet today. We care about the 50 million bucks worth of orders sitting on the desk.
Exactly.
But, I mean, that brings up a massive operational hurdle. It's one thing to promise a client you can build tens of millions of dollars worth of complex testing equipment. It's another thing entirely to have the cash, the raw materials, and, the actual factory floor space to physically build it.
Which is exactly why we have to transition and look at the balance sheet. A massive backlog is totally worthless if you can't fund the operations to fulfill it.
Right, let's dig into the cash flow. As of late February, Aehr sits on $37.1 million in cash and cash equivalents.
Which sounds good.
On the surface, yeah, that looks great because it's up from $31 million in the prior quarter. But here is the massive catch.
Let's hear it.
Their operating cash flow saw a $3.7 million burn in Q3. The core business actually lost cash. The only reason their bank account balance went up is because they maxed out their $40 million at the market, or ATM equity program.
Right. And for some context for the listener, an ATM program allows a company to issue new shares of stock directly into the open market.
Okay.
It lets them raise capital on the fly at whatever the current market price is.
Wait, so they funded this capacity by essentially diluting their own shareholders. They just printed more stock to pay the bills. Is that a glaring red flag for you, or is it just a necessary evil to execute this massive pivot into AI?
Well,
Because fundamentally, nobody likes their slice of the ownership pie getting smaller,
it is the ultimate double-edged sword for a growth investor. But management would argue it's the very cornerstone of their bull case.
How so?
Aehr isn't just patching holes in a sinking ship. They are executing a massive 5x capacity expansion. They are radically scaling up their supply chains, securing specialized components, expanding clean room manufacturing.
Like basically a total overhaul.
Yes. And they're doing all of this to handle a massive surge in artificial intelligence orders.
So they are abandoning the EV narrative entirely and going all in on the AI data center boom.
Right. They're winning major contracts with hyperscalers.
And these are the massive tech giants building out the global data center infrastructure.
Exactly. These hyperscalers are ordering Aehr's Sonoma and FOX XP systems, which are used specifically for testing AI chips.
Okay.
And the AI infrastructure race is moving at breakneck speed right now. If a hyperscaler tells Aehr, hey, we need to test millions of AI chips, can you handle the volume? Aehr cannot reply, give us 3 quarters to save up our profits to build a new facility.
Right, because if you say that, the hyperscaler just walks across the street and gives the contract to your competitor.
Precisely the point. You have to have the capacity online yesterday. So Aehr used the ATM program to raise the cash, diluted the existing shares slightly, and deployed that money to quintuple their manufacturing capabilities.
So they're buying the massive factory space today to secure the hyperscaler contracts tomorrow.
Right. And management expects this aggressive gamble to pay off quickly. They're actually guiding to return to profitability by Q4 of this current fiscal year, 2026.
Wow, that's soon.
Yeah, they even put out full-year revenue guidance at the high end of their $45 to $50 million range.
So they're burning cash and diluting shareholders right now, specifically to capture this AI market share before the window of opportunity slams shut.
It's a high-stakes, very aggressive strategy, but clearly the market is completely buying into the narrative, which brings us to the actual price action.
Yeah, let's talk about that.
The charts on AEHR are just reflecting pure, unadulterated momentum.
Here's where it gets really interesting, you guys, because the momentum is just staggering. As of our recording on April 13th, the stock is trading right near its 52-week high of $74.53.
It's wild.
It has violently blown past all of its major moving averages. I mean, the 50-day moving average is way down at $34.41. The 200-day is even lower at $25.38.
And we really have to pause and look at what those moving averages actually represent.
Right.
A 200-day moving average is roughly the psychological cost basis of long-term holders. So when the current price is, $50 higher than that 200-day average, it means the average long-term investor has doubled or tripled their money.
Right. Right.
That distance shows incredible buyer conviction, but it also creates a massive vacuum underneath the current price.
Yeah. And the support levels are miles below where we are trading right now.
Yeah.
Key support is hovering way down near the 20-day exponential moving average of $37.18. And previous breakout zones are around $50. But if you look at the momentum indicators, they are practically melting. The RSI, the Relative Strength Index, is sitting at 77.05.
Yeah, an RSI of 77 is extreme.
It's like redlining your car's engine in second gear,
Hmm.
Sure, you're accelerating incredibly fast, and you might get away with it for another mile. But the mathematical reality of the engine dictates that you either shift gears, meaning the stock consolidates and trades sideways, or the engine eventually blows and you see a sharp pullback.
That is a perfect way to visualize it. An RSI over 70 statistically indicates severe short-term overbought conditions.
Hmm.
But then you have to pair that with the MAC, the moving average convergence divergence, which is sitting positive at 3.55.
Okay, wait, what does a positive 3.55 actually signal about the people buying this stock right now?
Well, the MACD measures the distance between short-term and long-term momentum. A high positive number like 3.55 means that the short-term buying aggression is completely overpowering the historical trends.
So it's not just hype.
Right? It confirms there's massive institutional volume behind this upward thrust. It's not just a few retail traders clicking buy. It is heavy, sustained capital inflow.
And Wall Street analysts are just aggressively fanning the flames. I mean, the consensus rating across the board is a buy or strong buy.
Oh, yeah.
Craig Hallam just upgraded them to a buy with a $68 price target. Lake Street raised their target to 56, also maintaining a buy, and William Blair upgraded them to outperform, putting their fair value somewhere between $50 and $70.
But do you notice the glaring irony in those numbers?
The stock is already trading above all of them.
Exactly.
It's at $74.53. It is blasted right past Wall Street's own quote-unquote strong buy price targets. The analysts are publishing these deeply researched reports saying, buy it, we think the math supports a move to 68, and the market is essentially yelling back, we are already at 74, your spreadsheets are too slow.
Yeah.
How does the market entirely decouple from the analysts' discounted cash flow models like this?
Well, if we connect this to the bigger picture, this is the exact mechanism of how a fundamental narrative overrides traditional valuation. In this case, the AI infrastructure boom collided with aggressive institutional buying.
Right.
Institutions own roughly 69.7% of this company. When that April 7th earnings report hit, despite the massive 44% revenue miss, institutions saw the $50 million backlog and just bought the dip with overwhelming force.
They pushed the stock up 23 to 26% almost immediately post-earnings.
Yes. And let's break down the mechanics of what happens next.
Right.
When institutions buy millions of shares, they force the stock price above key resistance levels. That upward crossing triggers algorithmic trading bots, which are programmed to instantly buy when certain mathematical thresholds are breached.
Oh, wow. So it cascades.
Exactly.
Yeah.
That creates a synthetic, automated upward draft. By the time everyday retail investors see the green arrows trending on their brokerage apps and jump in out of FOMO, fear of missing out, they are riding the top of a bot-driven, institutionally funded wave. The momentum completely overrides the $68 fundamental price target.
But riding a bot-driven wave with an RSI at 77 is incredibly dangerous, which transitions us perfectly into the bear case.
We have to talk about it.
We absolutely do, because we have to ask the critical question here. Are we looking at an undervalued, misunderstood AI darling, or just a highly toxic value trap?
The bear case has substantial evidence, and it really starts by looking at who is quietly taking their chips off the table.
Right.
We know institutions were buying the post-earnings dip, but company executives have been aggressively doing the exact opposite.
Which is a major red flag. If you look at the SEC filings from late March and early April, top executives at Aehr have been filing Form 4 and Form 144s for proposed stock sales.
Yeah, heavily.
In fact, one officer sold approximately $4 million in shares right into the teeth of this massive rally.
And we really have to analyze that divergence. On one side, you have algorithms, retail traders, and institutions piling in on the promise of the AI future.
Right.
On the other side, the insiders, the people who actually sit in the boardrooms, look at the supply chains, and know the daily operational friction, are cashing out millions.
That's scary.
Now, insider selling isn't automatically a death sentence. I mean, executives buy houses, they pay taxes, they diversify their portfolios.
Sure.
But executing $4 million in sales right at a 52-week high, while the RSI is screaming overbought, is a data point you simply cannot ignore.
And it becomes even harder to ignore when you look at the valuation. Because if you're buying Aehr at $74, you are paying a stratospheric premium.
Stratospheric is the right word.
Their price-to-sales ratio, the PS multiple, is currently sitting between 20x and 43x, depending on whether you are calculating trailing 12 months or forward projected revenue.
Right. And to ground that in reality for a second, the semiconductor testing industry average is about a 6x price-to-sales multiple.
Okay, so 6x versus 40x.
Exactly. Massive, highly successful peers in the space, companies like Teradyne, trade much closer to that 6x industry average. Array is trading at roughly 40 times sales.
40 times sales. I mean, let's put that in perspective. A 40x price-to-sales multiple means that even if Aehr captured 100% of their projected AI testing market and operated with utterly perfect profit margins, it would still take them a decade just to earn back their current market capitalization.
It's wild.
The market isn't just pricing in successful growth, it is pricing in an absolute flawless monopoly.
And remember that $40 million ATM equity program they just maxed out to fund the factory expansion?
Yeah.
Well, they just launched a brand new $60 million ATM equity offering.
Wait, seriously? So more dilution is coming down the pipeline?
Yes, they desperately need that fresh cash to keep the 5x AI capacity expansion moving, especially because the EV silicon carbide business is still dragging on their bottom line.
Ah.
So the AI narrative is basically carrying the entire weight of this extreme 40x valuation.
So I have to ask the critical trap question for the listener. If insiders are selling millions at the very top, and the company is actively preparing to dilute existing shares by another $60 million, all while the momentum indicators are literally redlining our everyday retail traders getting trapped holding the bag at 40 times sales.
This raises a really important question about the concept of margin of safety. In investing, your margin of safety is the mathematical room you have to be wrong.
Right.
When you buy a mature semiconductor stock at a 6x multiple and management completely botches a quarter, the stock might drop 10 or 15%, but it has a fundamental floor built on its actual cash flow.
Makes sense.
When you buy a stock at a 40x multiple, you have zero margin for error. Absolute, unyielding perfection is already priced into the $74 stock price.
So there is no safety net. They have to execute flawlessly.
Flawlessly. If the AI hyperscaler contracts face even a month of delays, if there are unexpected supply chain bottlenecks in acquiring the parts for their 5x capacity expansion, or if the overall data center spending slows down by a fraction of a percent,
The floor falls out.
exactly. The stock completely lacks the fundamental floor to support $74. That is the textbook definition of a potential value trap. You buy in believing you're capturing a growth machine, but mechanically, you're just paying the absolute peak premium right before the reality check hits.
Wow, okay. So let's bring this all together for the listener to summarize what we are looking at. We have a mountain of conflicting data.
We really do.
On the bull side, we have a record $50.9 million backlog, aggressive hyperscaler contracts, and a massive 5x capacity pivot to become the testing backbone of the AI data center boom.
True. But on the bear side, we have a stock trading at 40 times sales, executives quietly cashing out millions, the core EV market dying off, and a fresh $60 million dilution risk hanging over the market.
So if we break this down into actionable timelines, what are we looking at?
Well, in the short term, meaning the next few days or weeks, the stock shows extreme vulnerability to a sudden pullback or aggressive profit take.
Yeah, I'd imagine.
That RSI at 77 and the threat of the new ATM offering are incredibly heavyweights. The only thing preventing gravity from taking hold right now is the sheer force of institutional momentum and the algorithm cascade we talked about earlier.
It's entirely a momentum trade today.
Yes, absolutely. But if you look at the medium to long-term outlook, the stock chart stops mattering entirely, and it completely hinges on operational execution.
Can they deliver, basically?
Exactly. Can management seamlessly translate that $50.9 million backlog into the Q4 profitability they promise without needing to dilute shareholders beyond this new $60 million ATM?
Right.
If they can deliver the physical systems to the hyperscalers on time, the bull case remains intact and they slowly justify the premium. If they stumble even slightly, the downside is incredibly steep.
So what does this all mean? It means Aehr Test Systems is a classic high-stakes battleground stock. In one corner, you have a revolutionary AI backlog and a management team betting the farm on capacity expansion.
Right.
And in the other corner, you have terrifying fundamental valuations, insider selling, and literally zero margin of safety. It's a fascinating setup, but it is certainly not for the faint of heart.
Definitely not.
Remember to hit that like button, subscribe to the channel, and drop your thoughts in the comments. Are you riding this institutional AI momentum, or are you staying as far away as possible from a 40x multiple? We really want to hear your take.
And, as you think about your strategy, consider this one final detail. We know the $50 million AI backlog is real today.
Hmm.
But if Aehr's entire premium valuation is built on being the picks and shovels provider for the AI infrastructure build-out, what happens to a zero margin of error 40x multiple if the broader AI boom even slightly pauses to catch its breath?